Hi, this video is the second of a two-part series on calculation of goodwill, and that's all we're going to do in this video, so it's a fairly short video. If you have not seen the first part, I would suggest that you check out the first video as that deals with the basics on calculating goodwill. And before we start, I would like you to know that I'm using IFRS standards for this video. And IFRS allows two theories, so we're using the entity theory, and often that's referred to as the fair value enterprise method. So under this particular theory, when we have non-controlling interest shareholders, they receive their own proportionate share of fair value increases or decreases, as well as a share of goodwill. Under the other theory, they don't receive a share of goodwill, but this is more common, so that's what I'm basing this example on. So the first video dealt with 100% ownership and three basic examples. In this video, we're just looking at how to calculate goodwill with less than 100% ownership. So here's the example that I'm using. We're a parent company, and we purchase 80% of the shares of a subsidiary for $1.2 million. So we didn't buy the whole company, but we certainly purchased controlling interest, and therefore consolidated financial statements are required. So here is the balance sheet of our new subsidiary along with fair values at acquisition. And if you have a look here, you can see that the inventory has a decrease to fair value, plant and equipment at net goes up. This subsidiary had existing goodwill on its own individual statements, and then long-term debt here has increased in terms of fair value. So this is going to be, as well as an example of less than 100% ownership, a bit of a review of how to allocate an acquisition differential. So first, a note on goodwill in the individual books of the subsidiary. We do not include that goodwill as an asset at all when we do our own calculation. So what happens effectively is that we wipe out the subsidiary's goodwill, we replace it with a brand new calculation and one single number on the consolidated financial statements. And if you think about it, this makes a lot of sense. First, we're doing a brand new calculation. We don't know if the subsidiary kept their impairment up to date with goodwill. As well, if we didn't get rid of it, we'd have two figures for goodwill on the consolidated statement, theirs and ours. So make sure that when you see goodwill on the subsidiary balance sheet, that you deduct it from the book value of net assets before you calculate goodwill. And that's why it's on this example, so you can see how to do that. So the first thing I like to do is calculate goodwill using fair values. The reason is that this is a very simple, quick, and accurate way to calculate goodwill. You're almost guaranteed to get it right, and then you have a check figure for the second calculation. So I've reproduced in this table the fair values, and you can see that assets of the subsidiary at fair value, and again not including any existing goodwill, are $1,890,000. $740,000 in debt leaves $1,150,000 net fair value. So the first calculation you need to do here is to imply the full value of the subsidiary. So you purchased 80% of this subsidiary for $1.2 million, and if you divide, you'll take your 1.2 million divided by 0.8, and that gives you a proportionate number for 100% of the subsidiary. So this is the fair value enterprise method, which you're going to commonly see under IFRS. So we're actually working with this $1.5 million figure that we've just calculated. Subtract the net fair value of assets, and we're left with goodwill of $350,000. So again, this is a very quick, easy calculation, and it gives you a check figure when you use book values and allocate your acquisition differential. So remember, our goodwill here was $350,000. Now we're going to calculate goodwill using book values, and I've reproduced the balance sheet here, and you might recall that the book value of the subsidiary can be seen as the book value of assets minus the book value of liabilities, or simply add up your shareholders' equity. So shareholders' equity is what I've used here. Notice that that's common shares plus retained earnings, but we do again have to deduct the existing goodwill on the books of the subsidiary. So that $30,000 has to come off. The starting figure is just the same as the other method. We need to find the implied value of the full 100%. So 1.2 million divided by 80% gives us the implied value. Now there are some more advanced methods that could be at work here, so depending on your course you may see a couple of variations on this, but this method is the basic method. So we take our implied value, subtract the book value of the subsidiary, not including goodwill, and we get an acquisition differential of $510,000. When we allocate that, you'll notice that inventory went down, so inventory, an asset, goes down with a credit. Plant and equipment was up $200,000, so to increase this asset, that would be a debit. Long-term debt increased, so a liability that goes up is a $20,000 credit. When we put these together, we have a $160,000 debit. So this is an increase over book value. It uses up your acquisition differential. So 510,000 less 160,000 allocated gives us goodwill of $350,000. So that's all we wanted to do in this example, is go through partial ownership, but we've also looked at goodwill. And now you should be able to calculate goodwill no matter what you see on your opening question and always get it right.